marginal costing versus absorption costing. So, how to treat the fixed cost under marginal costing? Fixed costs are not included while computing cost per unit. It means it is not going to be charged as a cost of product. Under absorption costing, fixed overheads are charged to product to be subsequently released as a part of cost of goods sold. That is, it is included in cost per unit. But in marginal costing, it is not included in cost per unit. Coming to the profit, profit in marginal costing is ascertained by establishing the total contribution. By establishing the total contribution, it means, first of all, we will deduct the total variable cost from the sales. Then we will get contribution. After that, we will deduct the fixed expenses from the contribution. Finally, we'll get the profit. Here, profit is the difference between sales and cost of goods sold in the absorption cost. Next, classification of costs. Under marginal costing, costs is classified into fixed cost and variable cost. And cost volume profit relationship is an essential part of the marginal costing. But in absorption costing, costs are rarely classified into variable and fixed. Although such a classification is possible, it fails to establish a cost volume profit relationship. Valuation of inventories. So, under marginal costing, inventories are valued at variable cost. So, if inventories increase during a period, this method generally reports less income than absorption costing. But when inventories decrease, this method reports more net income. Coming to the absorption costing, if inventories increase during a period, this method reveals more profit than the marginal costing. When inventories decrease, less profit are reported because this method closing stock is valued at higher figures. This method closing stock is valued at higher figures. So, recovery of overheads. There is no arbitrary appointment of fixed overheads because it does not consider the fixed overhead at all. But in absorption costing, apportionment of fixed costs is arbitrary, and this may result in under recovery of overheads. Under recovery of overheads. It means more actual overheads were incurred than the estimated. So, difference in profit under marginal and absorption costing. The above two approaches will compute the different profit because of the difference in the stock valuation. So this difference is explained as follows in different circumstances. So what are these circumstances? No opening and closing stock. In this case, profit or loss under absorption and marginal costing will be equal. There is no opening stock and closing stock. It means, so actually inventories are valued at variable cost in marginal costing. Okay, but here they'll consider variable and fixed cost while valuing the inventories. So if there is no such stock at all, both are equal. When opening stock is equal to closing stock, in this case, profit or loss under two approaches will be equal, provided the fixed cost element in both stocks is same amount. Okay. Next one, when closing stock is more than the opening stock. See, it is all about the valuation of inventories. In other words, when production during a period is more than sales. So production is more than sales. So in such a case, we have stock. We have closing stock more. And in absorption costing, the valuation of closing stock, it involves fixed cost. Okay. So, but in marginal costing, they will exclude the fixed cost portion. So, in such a case, profit as per absorption approach will be more than that by the marginal approach. The reason behind this difference is that a part of fixed overhead included in the closing stock value and is carried forward to next accounting period. So this is the point. And when opening stock is more than the closing stock, so in this situation, see, when production is less than the sales, so profit shown by marginal costing will be more because production is very less, sales are more. So profit shown in marginal costing will be more than that shown by the absorption costing. This is because a part of fixed cost from the preceding period is added to the current year's cost of goods sold in the form of opening stock. So all about fixed cost. Okay, whether to consider it or to exclude it. See, if fixed cost is considered in valuation of inventory, it means it is an absorption costing. If fixed cost is excluded, doesn't consider, then it is marginal costing. So these are the income statements as per absorption costing and as per marginal costing. In absorption costing, sales minus production cost. Production cost, it involves direct material, direct labor, variable manufacturing overhead, fixed manufacturing overhead. So cost of production. But coming to marginal cost, there is no sign of fixed cost in the cost of production. Okay. Next, opening stock of finished goods. Opening stock of finished goods. Value at cost of previous period's production. Previous period's production. It means that opening stock involves fixed cost also. But here, opening stock of finished goods, value at cost of previous period. So in previous period, they don't involve the fixed cost at all. See, less closing stock of finished goods. Value at production cost of current period. Value at current variable cost. Variable cost only. So cost of goods is sold. Here also cost of goods sold. Add under or over absorption of a fixed manufacturing overhead. So under absorption, when it happens, if they incur more expenditure than expected, then that is under absorption, under recovery. So here, variable administration and selling and distribution overhead. So finally, total variable cost they'll find. Okay. So from sales, we have to deduct total variable cost. Then we'll get contribution here. But here, after adding the under or over absorption, we have to add the administration cost and then total cost. So it already included fixed overhead. But here, after determining the contribution, they will deduct the fixed cost. Finally, net profit will be determined. So sales minus total cost is equal to profit in absorption costing. But here, sales minus variable cost is equal to contribution. Contribution minus fixed cost is equal to net profit. So this is the difference between absorption costing and marginal costing.